Thanks for clicking. Canada's fixed mortgage rate surged upwards on Friday, with Government of Canada bond yields surging 20 basis points in a single day, mostly on the news that the economy is doing much better than expected, adding 54,000 jobs in November. Well, yeah, bond yields are now just about where they were 1 year ago, despite 150 basis points worth of rate cuts coming from the Bank of Canada. And it's not just fixed rates. Economists are now expecting the bank to hold off on any future cuts throughout 2026, with some now even expecting a rate hike. With that said, as we'll see today, the market might be acting a tad hyperbolic, failing to account for the lag between economic shifts and those shifts trickling down through the real economy. So what I want to do today is go over Canada's unemployment data for the month of November, taking a look at what happened with rates, go over why this could just be a blip, and then discuss why Canada might not be out of the woods just yet. The Bank of Canada is set to make its next interest rate announcement on Wednesday with a press conference held thereafter, and we'll obviously have an update out on that, and then shortly thereafter we'll be awarding the 2025 Award for Excellence in Canadian Journalism, sending out both this trophy as well as some reading material for the governor and the media for the dedication they displayed this year.
You gave me an educational toy?
Make sure you click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data, November saw Canada's unemployment rate fall to 6.5%, the third month in a row of unexpected job gains. Job gains were mostly driven by part-time work, with 50,000 of those jobs coming from young people.
This changes everything.
Markets took the report to mean that rate cuts coming from our central bank are now over, with the yield on the 5-year Government of Canada bond up 20 basis points on Friday, though some of that increase was stemming from events coming out of the United States and Japan. With that said, we are seeing some early warning signs in the data, and not just that the majority of the jobs gained were that of part-time. The participation rate fell by 0.2%, reaching a near all-time non-COVID low, meaning more people have just given up looking for work, which has helped to push the unemployment rate down. Remember, if you just give up looking for work, you're not included in that unemployment data. StatsCan also noted that perceptions about job security are falling as well, all down significantly since November 2023, the last time StatsCan collected the data. And then finally, we can also see where the job losses are starting to pile up: manufacturing, wholesale and retail, real estate, etc. So the headline number, 6.5% unemployment rate, falling for the third month in a row, might look good on paper. If we dig a little bit deeper, there are some problems on the horizon. With that said, markets took the news to be more optimistic on the economy, and yields surged soon thereafter, with traders paring back bets of cuts coming from the central bank, though, as we'll see in a minute, those bets could very well be short-lived. Now, before moving on to some examples as to why we may not as of yet seen the effects of these US tariffs in the Canadian economy, there are any number of academic sources saying that this should very much be expected. The Bank of Canada says that we should expect 18 to 24 months for monetary policy pass-through. The Federal Reserve says that's closer to 4 to 29 months. And a paper from the IMF says that changes in fiscal policy can take multiple quarters or even years before the effects are felt. In these theories, these predictions matter, as if the predictions end up matching the data, then we know we're on a strong academic footing. And if the predictions don't match the data, then at least we'll get an invite to appear on Bloomberg.
No, you won't.
So let's try it. The last big non-COVID economic event was obviously the global financial crisis, which is generally accepted to have started in August of 2007, when French bank BNP Paribas announced it was suspending redemptions of its shares. August of 2007, that's when we first kind of thought there was going to be a problem, and then Bear Stearns doesn't fall until 7 months later, and then Lehman falls 6 months after that. In August of 2007, the unemployment rate was sitting at 6%, and then a year later, still sitting at 6.3%. And then, of course, we all know what happened shortly thereafter. Now, that's not at all to say that Canada is witnessing a Lehman moment, and it's certainly not to say that we're not, but it is a useful guidepost for understanding economic lags. Next one, let's take a look at the dot-com bubble. The Nasdaq peaks early 2000, and then drops 20% by July. During that time, the unemployment rate really isn't moving all that much, and a year later, it's actually lower in the United States. And then, again, we all know what happened shortly thereafter. Again, the big economic shift happens. We see the dot-com crash, but it doesn't actually show up in the data until well over a year later. Or even look at the money supply during COVID. M2 growth started to reach concerning levels in April of 2020, but we didn't see inflation pop up over 3% until April of the following year, not going over 4 until August of 21. A year and a half until the obvious materialized.
Shut up!
So, the lag between a big economic shift and it actually showing up in the unemployment rate, we're looking at a year and a half based on previous historical events. Now, I'm not sure if tariff uncertainty or the actual implementation of these tariffs register as big of an event as does, say, the global financial crisis. But taking all of this together, we have two very clear conclusions. First, the underlying economy is a bit worse than that which is being reported in the headlines, and any noticeable fallout from this tariff uncertainty from these actual tariffs should not have shown up in the data just as of yet. The steel and aluminum tariffs were first imposed by the United States in March of this year. The auto tariffs were imposed on May 3rd, and steel and aluminum popped up again in June. So, with November's unemployment data coming 6 months after these tariffs started to materialize, we really shouldn't be seeing anything glaring in the real economic data as of yet. But an intro understanding of global economics and the role of the hegemon tells us that that fallout shouldn't be that far off. And I wanted to bring up these economic lags, not to be hyperbolic, not to say, yeah, but just wait and see what happens next, but rather because we all know for sure what happens in the very near future. The Real Estate High Council is going to send out its representatives who are going to tell us the economy has rebounded, it's all over, interest rates are low, which they're not. Clear skies ahead.
Yeah, he got me.
But look, we've had the implementation of these tariffs for about 6-8 months now, and I think the writing is going to be on the wall. In a similar vein to you can't print all of that money within that short of a period and not expect to see inflation, Canada cannot expect to go into a major trade war with the global hegemon, with our biggest trading partner, and not expect there to be severe economic fallout. And all of that isn't even to mention what we've talked about so much on this channel, the ongoing uncertainty to do with CUSMA negotiations, which we've said before, the president is not going to negotiate quietly. Speaking of which, on that very briefly, just to clear up a common misunderstanding, the United States can pull out of CUSMA at any time it wants. It just needs to provide 6 months' notice. And even then, even without that clause, the US could withdraw at any time because the global system is anarchic. There is no state above the states. There's no 911 operator to call. Regardless, in addition to these historical examples, we can see news everywhere that the powers that be recognize what exactly is coming, and not just because they're spending money. Any politician anywhere will use a crisis to spend money and gain support. That's nothing new. But the Liberal Party making a deal with Alberta, which is very much going to cause that party a problem with Quebec, that very much tells me they know that something's coming. So, yes, decent unemployment data, decent economic data coming out of Stats Canada, but history tells us that that very likely will not last. There are big problems coming out of the United States, great big shifts, and what the previous shifts tell us is that it takes well over a year, 1 year, 18 months, for those shifts to show up in the economic data. As such, absent any major inflationary shifts, I wouldn't be surprised to see more cuts coming from the Bank of Canada at some point next year, especially when, ceteris paribus, we're going to be seeing them from the Federal Reserve. We will obviously consider to track Canada's economy and the fallout from this trade war on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.